Hey investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Every Friday around 9 a.m. Eastern Time, I try to kind of write this up or print this out or record this. You might hopefully have noticed I got a new microphone, so I hope that is better for everyone. So we have a lot to talk about here today. We've got 5 topics to go through today, so I hope that this is going to be really interesting for everyone. So we're going to talk about the interest rate environment and whether that's killing high growth stocks and my thought process about that. My thought process also about shorting. Then somebody asked me, and someone said, "Oh, management is dumping stock, and this is why X, Y, Z is happening." So I want to talk about that, and then finally, going to talk about diversification. This is something that is so important at most times, but right now, what does it actually mean, diversification? And the final topic, being a cockroach, what that means to be a cockroach in investing. So I really hope that it's going to be something that resonates with you people. So I've kind of put a lot of work into today's episode, so I really hope that it kind of works out. So someone asked me, why is it that interest rates are bad for high growth stocks? So you've seen in the past, let's say 2 months particularly, but it's been really happening since February, but in the past 2 months particularly, things have been really brutal out there. It's just blood, it's carnage. And why someone asked me, why does high interest rates, how does it affect that? So for some people, this is really common sense, but if someone asked me, that means that other people might not know about it. And if you're kind of new to investing, I kind of just wanted to put it out there. Hopefully that will be helpful for you. So the way it works is that you as an investor buying stock in a company relative to how much free cash flow you will get back from right now to infinity. Okay, so the way it works is that if the business is growing really, really fast, more often than not, it's investing its excess free cash flow back into the business. So you're gonna get more free cash flow in the future and you'll get less upfront. But if you have a high interest environment, so let me rephrase this. If you have a low interest environment, high growth names is the place to be, right? You have an asset that's rapidly growing, intrinsic value is growing, and you're going to get that intrinsic value much more into the future, but it's going to be huge, that intrinsic value. That's why, growth stocks have done really well. But if interest rates come up, that means that what people are discounting the future of those free cash flows, the discount rate goes higher. So you're going to require a bigger margin of safety. So just let's give you an example, right? So let's say that company XYZ is going to be really free cash flow generative in 2025. In a high interest environment, you're going to require a larger margin of safety compared with low growth company ABC. Low growth company ABC is not growing a lot, but is making a lot of free cash flow right now. So you're probably paying, let's say, a 10x multiple on the free cash flow. That means if you were to buy the company, within 10 years, the company would have paid for itself. So the 11th year and beyond, whatever you get is free upside. You've already you got your money back. So it's like gravity. That's how Warren Buffett talks about it, that in a high interest environment it's like gravity. And it's a bit of common sense as well, because at some point everyone's saying, we're back in the 2000s. We're not like in the 2000s. So in 2000, the interest rate environment was 5%, okay? And a lot of those companies, those high-flying companies, for example, let's pretend, like Yahoo, whatever, they were being priced at, let's say, 900 times forward earnings. I mean, it's not the same here, right? It's not really the same, A. B, the businesses have a lot higher quality right now. So it's not a like for like. And importantly, most people would agree that the interest rate is going to be around 2, maybe around like in the ballpark of that, okay? So it's not the same. So people like to kind of say stuff, but if you kind of think about it as, you just got to be independent in your thinking anyway. So I hope that kind of drives home the question the person had that I wanted to kind of share with everyone. So with all that being said, right now, so I'm recording this on the 28th of January, I think that we are kind of close to a turning point now in the market. Now, I want to make something clear. I cannot predict the market, you can't predict the market, nobody can predict the market. The only thing that I'm saying is that the pace of selling, the pace of indiscriminate selling appears to be slowing down slightly. Now, that doesn't mean that the next 2-3 trading days things cannot get worse. That, it's clear that things can always get worse. It just means that the pace of selling appears to be slowing down, and that from this point right now, the end of January, over the next 2 years or so, the risk reward is going to dramatically improve. Now, when it comes to the bottom of, when the bottom of the bear market, it's not that someone rings a bell and says, hey, it's the bottom of the bear market and everyone just rally up. It's not like that. And it's not that when you reach the bottom of the bear market, you kind of punch a little punch card and it's like everything soars again. What happens at the bottom of the bear market is just the capitulation of investors kind of slows down, and it reaches a point where people are like, whatever, I'll just keep the shares. You don't want them, I'll just keep them. So it gets exaggerated on the high end when things just kind of lose their lid, and it gets exaggerated on the low end. So this is kind of like the final drop, which is the worst, the most severe, kind of just people just like, kind of letting go. So this, when the bear market kind of the bubble pops, there's a kind of like a large large drop, and then it kind of like relentless selling, and then there's kind of just the last little bit to sort of poof, kind of people just dumping. And you, as an investor, you don't have to time the bottom in the market, right? It's not about trying to be the first one. And this is something that I kind of, when I was starting out investing, I always have thought, okay, buy the dip. And it's not about that. What you're trying to do as an investor is trying to invest when the odds are maximally in your favor. Buffett's rule number 1, don't lose capital. So it's really about that. You want to try not to be the first one to kind of go in and play the hero. I am personally fully invested. And the point of the game is not to say, okay, I'm going to time the market, I'm going to just jump right in. It's just about the time in the market. You kind of, every so often, you buy a tiny bit of when your salary comes through, but your mindset is a long-term game. I always talk about the 20-year game. So it's you staying invested for approximately 20 years. That's something that's, tangible for most people, even if you're kind of starting in your 50s or 60s or whatever. It's just that frame of mind of not trying to time the bottom and be the first one in, and like it's about when the risk reward looks okay, you average into your high quality companies. So a lot of people say, no, I'm gonna go to the side now, I'm gonna put cash on the side, and I think to myself, man, it's pointless arguing with people, but the time to go to the side was not now. The time to go, if you wanted to play that game, the time to go to the side has been any time in the past 7-8 months, or even if you wanted to like slightly sooner than that. But the time to go to the side is not now. The time to go to the side was then. Now is the time to go in. But anyway, my point is here, just don't despair and try not to get overwhelmed. Try not to kind of jump right in and kind of say double or quit, or kind of I'm going to double on my position, or this is going to the moon. I don't see many people say now that this is going to the moon, but try not to kind of rush in and kind of just go too aggressive. Just try and space out your investments and let time do its thing. I always talk about pacing out your investments every 4 weeks. You just kind of, a lot of things happen in 3 or 4 weeks in the market. So just slow it down, and you can't kind of speed up this investment process. Okay? Right. So I want to talk about shorting. So a lot of people get really frustrated when I say, okay, don't buy this stock, don't I'm not a short guy, and don't faff around with that. But when I say, okay, don't buy this company, people get really annoyed with me, and I get it. They own the stock, they're fully entrenched. They want to hear someone say, "Confirmation bias. You are a hero for buying X, Y, Z," and I get that, right? When I started out, I used to get really frustrated when people said that my business sucked, and it just was like, I want to prove a person wrong. But it transpires that when I was a beginner, they were right and I was wrong, and I wish I'd listened. But anyway, can't do anything about the past. So people get really frustrated, and even in Germany, from my recollection, it's illegal to short companies. So it's kind of like people don't like short sellers, and I'm not a short seller. But me saying don't buy X Y Z is not the same as me saying go and short X Y Z. It's me just saying there are better risk rewards elsewhere. Don't get involved there. So I'm going to highlight, if you don't mind. I'm going to highlight, because I write a lot about different companies, and it's sometimes kind of a lot of stuff gets buried, and since you're kind of tuning in to my show anyway, I might as well kind of just talk about things that interest me, and humor me, if you will, because a lot of stuff gets buried away. So I kind of just wanted to highlight two companies here that I find quite interesting. So one of them is Robinhood. They just reported their result last night, and you can see here since August. In August, I wrote Robinhood, too little upside for too much risk, prospects rely on Dogecoin. Then a month later, I wrote, looking ahead, this doesn't look good. And then in October, which is another month later, I wrote, near prospects dire, path to profitability in question. And then a month later after that, I wrote, Robinhood stock, worse than it looks. So from this one in November, worse than it looks. So if you can just disregard, the hindsight bias of the previous ones, but just focus from November, that stock is down, including the after hours sell-off. The stock is down 70% since that number 3. And so you could have pretty much avoided, me consistently saying this. You just kind of picked out the last several months, and you will see that just kind of taken with a grain of salt people's position. But anyway, I like reading through those comments and people saying that I didn't understand. They'll tell me, oh yeah, Kathy Woods is buying it, so if Kathy Woods is buying it, then therefore she knows something that you don't. And I'm like, Kathy Woods okay, I know that a lot of people kind of jump on her, and I'm not the kind of person to jump on the bandwagon, but remove the name Kathy Woods. Just because XYZ fund manager is talking their book doesn't mean that they're right, because they can sell the stock and you're not going to know about it, and don't buy it because someone else buys it, buy it because it makes sense to you. Anyway, wanted to share that with you. Feel free to let me know if you own Robinhood and your prospects on it, and I'll be really happy to discuss that further. So I mean, this is another stock. I don't know the guy on CNBC, some guy on CNBC, Josh Brown it could be. Everyone's like, oh man, Michael, you're so wrong on Matterport. You don't get it. You don't get the metaverse. And I'm like, yeah, I don't get the metaverse, but I do understand a little bit about investing, and I can figure out a little bit whether the risk reward is favorable or not. And when I put this article, strong prospects, rapid growth, but expensive, when I put this one, the first one in September, within a few days the stock was up 30%. I was like, people were just going crazy, just saying that I was so wrong, this and that and that. And over time, I wrote another one, the stock jumps, this is what you need to know, and I kind of went through and said, okay, I know the stock is rolling and I'm wrong now, but just be patient with me. And people were just kind of saying, oh, you don't get it, this is like the platform of the future, they're gonna buy out Facebook. Anyway, so kind of crazy. And then the stock sells off, and it's kind of interesting to read people's comments, because people are still kind of saying, people even now are saying that when it comes to investing, I'll take the CNBC dude over you. And I'm like, whoa, like, stock is down 60%, man. Don't he's done the pump and dump, and you're kind of holding the stock. Don't hold that stock. Anyway, wanted to highlight that one. And just humor me. So I got one more. I could keep going with this all day. But anyway, I just wanted to kind of highlight another one, the Sentinel-1 one. This one is a cool one because this is a cyber stock company, and it's not often that your biggest competitor is bad-mouthing you on the earnings call. But it was happened. CrowdStrike came out on the earnings call and said, I think they actually called Sentinel-1 out by name. I'm pretty sure. But if it didn't, that was enough for you to kind of understand they were really pointing the finger at Sentinel-1. I can't remember if they actually called it out or not, but it was enough. Like, you didn't need to kind of read between the lines. It was kind of quite clear there. And CrowdStrike was saying, these guys, like, they're delivering really poor quality, and you didn't have to be a genius, right? So you look at this and you see that stock is overpriced, gross margins mediocre best, probably arguably the worst gross margin cybersecurity. And the thing with cybersecurity is that, it depends a lot on AI. And what happens in cybersecurity is that it used to be the case that if you had a large a large database or whatever, and you were able to kind of keep out a lot of malware, and you had a lot of customers, people would just attack that company because it made a lot of sense, because you'd get the most return on investment as if you're going to launch some spyware, right? Because that company has a lot of customers, and you would hold them up to ransom, and it made a lot of sense. So it was kind of like economies of scale were working against your favor, because you had a lot of customers, let's say, and the developer would just kind of develop some code to kind of attack that virus specifically, and it was kind of, you never were able to get to a large scale, because as a cybersecurity company, the bigger you became, the more of a target you became. But recently, with AI, this has changed. And in the case of CrowdStrike, actually, the more customers they get, the more iterations of the software they can take, and scale actually works in their favor. So it's a different ballgame. So yes, it's important, and the market's kind of, the market is often right? And the market is more often right than wrong, and people don't like to say that, but it's true. And when it comes to it, in the case of cybersecurity stocks, they were all just kind of really soaring higher, and the market is right. But I just said, okay, the market is right on cybersecurity as a whole. The market is wrong on Sentinel-1. Anyway, moving on. So the past several months have been really choppy, the market, and anyone could say, can build very quickly a narrative of why a stock is selling off, and they can do it really, really well. So here's one argument. So people are saying to me, XYZ, the CEO is selling stock, and they're like selling a few, like 2-3% of their holding, and people are like, they're selling stock, it's clear, it's so clear. And in a choppy market, it's really easy to build a narrative and to sell a story of why a stock is down. It's really easy in hindsight to say, I could have told you, if you just followed my insights, the CEO is selling stock, and therefore the business was never going to recover, and anyway, so if anyone has kind of remained long only, you have to kind of put up with this kind of stories. And I wanted to just highlight 2 examples, just because I'm kind of running out of time, but I just wanted to highlight 2 examples. So Jensen, I can't remember his name, the CEO of NVIDIA, someone's going to write to me, some NVIDIA shareholder's going to write to me and say, how do you not know this? Jensen, I can't remember his name. Anyway, so NVIDIA CEO has been selling so much of his stock for more than 10 years, and that hasn't stopped the stock getting close to, 700 billion market cap. So that's one example. The other one that I kind of wanted to highlight for you is that when Steve Jobs left Apple, the first time around, he dumped all his shares apart from one stock. And actually, the bulk of Steve Jobs' trust fund comes from his ownership of the amount of stock that he owned in Disney. So, and obviously Apple is like $1 trillion or $3 trillion company now. So, just because the CEO is selling shares does not mean anything. And a lot of people kind of build the story of why the stock is down, and because the CEO is doing this, that, the other. Think through the business, try to understand the business prospect, try to think through in your mind, what is the problem that the business is trying to solve, And is the business actually succeeding in solving? The easiest way to see this is not so much looking at the revenue growth rate, to see the customer growth rate. If customers are flocking to it, that's, Peter Lynch was right. I know that people say, Peter Lynch and Peloton and this doesn't work out. But I mean, it just depends about, not every single case is going to be right. And for every quote of Peter Lynch or Warren Buffett or Charlie Munger, there's a counter quote that you can put to make your case. But ultimately, if the customers are going towards, let's say, iPhones, the customers are going towards the cybersecurity company, or the customers are going towards whatever the stock is, it makes sense that you're able to get some pricing power because there's a lot of demand. And if you get some pricing power, the ability of the business to grow its revenues, the ability is high, right? So you have a good opportunity, good prospects, and if you just stay as a business owner for a period of time, you're going to be rewarded. And that being said, I know that the market has been really, really choppy right now, so it's been quite difficult to be a long-only person. But anyway, so I just want to kind of highlight that one. So I've already kind of touched about this. So ultimately, when it comes to investing, it doesn't matter about getting the best company or not. You don't need to get the best company. Most mediocre businesses, I know that only approximately something like 5% of all the stocks in the S&P actually drive something like 80% of the return of the S&P. But you don't need a killer return. You're just working your hardest to get towards 15% per year. And right now, anyone's 15% would seem amazing, but it's been a difficult period. That being said, if you're just aiming for 15% return over time, you don't have to trade in and out. What you do is you have to put in the work to have a conviction to stay the course. And that's more important than anything else, is just the ability to have a conviction to hold on, stay tight. Because what happens is that emotions kind of take over and people kind of end up being really overwhelmed when stocks sell off, and you kind of end up just dumping stocks at the kind of worst time just to get rid of that pain. And then they start talking about taxes. I want to for tax loss season and whatever. And taxes is just a distraction. So you just kind of try to stay the course. That doesn't mean you need to stay the course forever, but there's a difference between staying the course forever and dumping the stock at the worst possible times. I just want to kind of put that out. Kind of running a little bit out of time here. So I wanted to talk about diversification. And a lot of people say that, I'm diversified and I own this SaaS stock and I own that SaaS stock and I own the other SaaS stock, and that's not diversification. You're going to take different portions of the economy. Now, within that, for example, I run a hybrid portfolio. I have some kind of value names and I have some kind of growth names, but you don't need to follow my strategy necessarily, but you do have to try and kind of pick out different parts of the economy. Some people said, I'm all in commodities. I got commodities and I got this and I got some Bitcoin, and that's fine. It's not a strategy that I developed, that I do, but that makes sense because a lot of people are just kind of running the same idea and just changing the ticker symbol. And you see how things have gone right now, and that's absolutely okay over a long period of time, but the market can be really testing in a kind of a short period of time of 2 or 3 years, and you'll kind of get fatigued. You'll kind of get, your stamina will go for holding these businesses, and you'll doubt yourself, and then it becomes like I mentioned before, the stop clock, where you kind of just end up exiting that stock at the worst possible time, and it kind of winds the clock back up because you're kind of having to go into a new position, and it's kind of another 2 years for you to get your return out. So that's why I call it a stop clock, and it's just, you kind of end up kind of starting the clock again in a new position and building a new position from scratch, getting to know the business, trying to understand the problems of the business, the risks, the opportunities, the margins, the competitive landscape. So it's important, even if you just want to own SaaS stocks, it's important to understand that there's not a lot of diversification, and that when the market sours up, you're going to get really flushed out. Now, you can't do that strategy it's not a strategy that I recommend. You can't do that strategy, provided it's not that you are a buy and hold as long as the share price is going up, and then you're going to get overwhelmed when things go sour. Because when the market is kind of going up, everyone's buy and hold forever. Best company. This is the portfolio for the next 10 years. The market changes a lot in 2 weeks. 10 years is a long time. So just think through that. I hope that kind of is kind of useful. When it comes to it, you don't have to kind of have commodities or whatever. You can migrate towards high quality businesses. You can have some social media, you can have some, let's say, some database company, you can have some infrastructure company, you can have some semis in there. That's fine, but you just need to know what kind of investment strategy you're working with, because if things go sour as they are doing right now, you don't want to be doubting yourself at the worst possible time. You need to do the preparation before you start buying the business. It's like the athlete. I always talk about like an Olympic athlete. The Olympic athlete kind of knows before the race is done whether they're going to win or not. Or the from the Art of War, where he says that the battle is fought before it's even started. So it's kind of like you have to do the preparation to your business analysis. You have to kind of understand what you're getting yourself into, what's your portfolio strategy, what's your investment strategy before you buy into businesses. When you're in the trenches, it's too late, So yeah. So this is kind of my final topic. I have a bit of a run here today. I normally just like to run this for about 20 minutes. Let me know if half an hour or whatever is too long for you. If you could just drop it in the comments, that's quite helpful. Because someone wrote to me, I prefer just the 5-10 minutes, and I'm trying to kind of cater. I can't give too much knowledge in 5-10 minutes. It's quite difficult, but maybe half an hour is too long as well. So when it comes to buying a business, I always think back to buying a property. So when you buy a property, there's only 3 things that really matter, right? Location, location, location. When it comes to buying businesses, there's only 3 things that matter here: earnings, earnings, earnings. So you need to know whether the free cash flows, how much is going to be, for how long, and how certain, right? So when it comes to putting a multiple on a stock, these are the 3 factors that you need to think about, right? When you're paying a premium, whether it's small or large, to the underlying future free cash flows, you want to understand how profitable the business is going to be over time, how sustainable, the visibility that you have into that, and the conviction. Everything boils down really to that. It doesn't matter too much right now what the share price is doing. What matters very much is the underlying business. What the business is trying to solve, and the longevity of the business. That's really what's at stake. So I call this kind of cockroach investing, because the cockroach investing is kind of like you knowing that after the market has melted down, you will come through at the other end. You personally watching this video will not be harmed, and you will survive, you'll get up, and you'll get through it. And the business will survive and get through it, irrespective of what the market is telling you right now. And it seems really hard and difficult to believe this, but deep down, it's true. And businesses are very much real, and being invested in them, you will see them continue to press forward, press ahead, irrespective of the turbulence in the market. And trying to time the bottom of this market sell-off is impossible. There's a lot of panic right now. Very few people are trying to think about the next couple of years. Most people are struggling to think beyond the next 30 days, how things are going to look at the start of March. People are just, right now, it's kind of like very agitated. So I really hope that this kind of 5 topics helped you out today. Do be sure, please, to drop me a like below. If someone kind of wrote to me on Seeking Alpha, I want to put a like out, because there's no way for me on Seeking Alpha to put a like, and that's really kind, really, that's most kind. So we're kind of going into the earnings season. It's going to be really, really crazy period, particularly because starting next week, we've got Amazon kind of reporting their results, and we're going to see how Google is going to do. Also, remember, the week after that is really where the mid-caps start reporting, and that's going to be really, really crazy, because there's an army of analysts following these kind of mega caps like Apple. There's such a large army following these companies, so everyone kind of knows more or less what they're getting in store. What is going to be really insightful is to see how the smaller businesses are coping with the global supply chain and how inflation has impacted them and their visibility. So it's going to be a really turbulent couple of period. I think that the market is already kind of really pricing in a lot of pessimism. People are really, really doubtful. I think it's going to be, I can't predict the future, obviously, but I just think that it's going to be a very interesting period. I think that, I'm hopeful that the risk reward right now over the next 2 years is really, really compelling. It makes a lot of sense to me. A lot of these businesses are doing really terrific things. So I'm very excited. I hope that you're excited. And thank you so much for listening. Thank you for your time. Have a good weekend. Bye-bye.